Minisode 29 of Futures Radio Show, sponsored by CME Group, the world's leading and most diverse futures and options exchange. CME Group's markets help individuals and businesses around the world effectively manage risk. For access to free educational tools and resources for the active individual trader, please visit activetrader.cmegroup.com.
Every day, traders and investors dive in to tackle the ever-changing markets to find opportunity. Futures Radio Show is your number one source for answers to the questions that all market participants want to ask. Veteran futures trader Anthony Crudele sits down with the most influential leaders and top traders in the industry. Now, here's your host, Anthony Crudele.
Hey everyone, before I begin today, I want to thank our sponsors. CME Group, Trading Technologies, RJO Futures, and Top Step Trader. Today I had the great pleasure of speaking with two of my favorite people in the financial industry, independent trader Yra Harris and Peter Boockvar, CIO of Bleakley Advisory Group and editor of the Boock Report. We began our conversation today by discussing Larry Kudlow's latest comments about tariffs. We chatted about trading markets in a tightening cycle versus an easing cycle. I asked Ira and Peter what they think of Fed Chair Powell and if the new Fed Chair has had any impact on the markets. Finally, they both gave us insight on treasuries, yield curves, the dollar, and gold. As usual, thank you all for listening, and please enjoy this episode. Ira, Peter, welcome back to the show.
Thanks, Anthony.
Thanks, Anthony.
It's great to speak with you guys. A pretty wild day in the markets, and it started off today with Larry Kudlow coming out and talking tariffs. I actually put a tweet out in the middle of the day, tariffs matter, then they don't, tariffs matter, then they don't, but price always matters, and trading off of these tariffs lately has been, as a trader, it's just a fool's game because they only matter for a matter of minutes or hours, and then beyond that, it's just been a back and forth, and you really can't hang your hat on whether or not they're going to matter or not. So you two guys are two individuals I always look for insight as to what's happening in the market beyond the charts. So we'll start off with you, Ira. What'd you think of what Kudlow said today, and what are your thoughts on the tariffs in general?
Well, Larry Kudlow's in a very tough position. He's trying to defend what he has been philosophically opposed to for a long time. And right before he accepted his job, or right after I think, he discussed that role of, now that I'm going in there, it's king dollar, so get long dollars and get short gold. Well, I'm not, as I wrote that night after he said that, I think he's created a trap for himself because this administration does not want a strong dollar. In fact, I think they're very adamant that they're willing to use the dollar as a tool to pry open some of the markets that they think have been closed or treated the United States unfairly. So this is a tough road for Kudlow to balance out. And I think you saw it today. I think he's getting kind of frustrated because right now he's the point man for this. And they send him out there because he's he's very media savvy, and he knows how to talk to this issue. And, he was on Bloomberg on Friday, which I listened to, and I thought Bloomberg treated him very, very badly. And he pushed back hard. And I said to somebody from Bloomberg, I said, that's a bad thing because you want access to Larry Kudlow. And today you saw this was a CNBC deal, and Kudlow, was very open and accessible to him. But he's caught in a very bad situation here, and he's trying to balance this out. I think it's a tough task for him.
Peter?
Yeah, I agree with Ira. He's having to walk this fine line of philosophically being against tariffs, but then having to defend what Trump wants to do. And, are we reaching a point where the administration is going to push this because they want a victory, as opposed to really laying out what the most effective tool is to get what they want? My problem is that I understand the desire to come to some sort of an agreement with respect to U.S. intellectual property and the protection of it, but this obsession on the part of some in the administration to trade deficits is just economically nonsensical. And I don't know what their end game here is, because I don't think they appreciate the collateral damage that a lot of these tactics cause. I hear Wilbur Ross say, "Oh, well, it's only going to cost the economy, a few tenths of a percent, and if consumers have to pay a couple extra dollars, it's no big deal." Well, say that to the farmer in Iowa. Say that to the small producer of widgets that has an input of steel. I think there's a lot of distortions that this creates, and I don't think that they appreciate it. And I'm not clear at all how the approach they've taken is going to somehow get China to the table. China is not some tiny little economy. It's the second biggest economy in the world, and they're not going to get pushed around by the U.S. Now, I'm not necessarily defending their trade tactics per se, but I just don't think that bullying is the way to come to some sort of an agreement here. And I don't think they appreciate the potential consequences.
I think Peter's, if I may add, is absolutely right. And the fact that they don't appear to have an end game, that they're flying by the seat of their pants. Now, they might have an end game. Why should they tell anybody, what their end game is? But it just seems to, there's a lot of, they're moving all over the place. And we know it from a trader's perspective, you better have some type of end point. That's the strategic end of this. If everything's just tactical and you move from one situation to another, you can get yourself into some very serious problems, especially because you really don't have as much leverage as they want you to believe. But we'll see. And I think the point, and I think Peter raised it very well initially, and got picked up by others. But if you start playing in this currency arena, as we go, and now people are picking up on it, if we go back to August of 2015, when the Chinese announced that they were depreciating yuan 3%, we saw the havoc that it created in the marketplace. Well, they got a lot more room to play here, and with it comes a lot of collateral issues. But again, we wish that there was a more strategic rather than just tactical approach to this.
Now, as a trader, I always go back to the impact on the market. And as a trader or an investor, the tariff headlines have been impacting the market in a negative way, as you guys just spoke about. And I think that Peter made a great point. And Peter, you said to me earlier, you said, when we're in a Fed tightening environment, bad news is actually bad news, versus when we're in a Fed easing environment where the markets seem to shrug off bad news and it just seems like everything is good news. So that's why when I hear about these tariffs, I feel like nothing has really been done yet, but the market is now more sensitive to bad news.
Right, because essentially that Fed put is out of the money, and far out of the money, where the strike price is way out of the money. And it's also a lot of success and failure in markets is getting the flows right. And now the flows are going the other way, whether it's via rate hikes or it's the shrinking of the Fed balance sheet. And all any investor has to do is look at what markets did after QE1 ended. We fell about 20%. What happened after QE2 ended? We fell about 20%. What happened right around the end of QE3, actually right before it ended? Well, we fell more than 10%. What happened 2 months after, a month after the Fed first raised interest rates? Well, we fell 10% plus. It's not like this is something new. This has been going on for a long time during every rate hike cycle. Markets become more vulnerable. Like I said, that put is out of the money. The Fed is not your friend. So, people that played the don't fight the Fed on the easing side, well, what are they going to say now that the Fed is tightening? And then you throw in, well, the ECB just cut their QE by 50%. Well, look at what the European stock markets have done. They're all down on the year. So bad news becomes bad news, and that when the rate hike cycle goes the other way, things are exposed. All the warts and pimples out there are exposed for what they are. They're not covered up by money printing. They're not covered up by zero interest rates. And like you said, we become much more sensitive to these externalities. Like the Facebook privacy thing. Now, granted, there is people asking questions about their business model, but I think the response is more exaggerated when you get into this other side of the monetary policy cycle. We reached peak easing last year, and while the ECB and the Bank of Japan are still feeding money into the financial system, so in the net aggregate, there's still more money out there. The analogy that Ira's probably heard me say this is that you're blowing air into a balloon. That air is all the easing, but if less air is going into the balloon, air is still going in, but that balloon is going to contract. And I think that's what we're seeing here, and which also raises a very interesting time in the markets as we enter first quarter earnings, because we know the bar is very high. There's a lot of excitement about earnings growth, well, in part because of the tax cuts, but also we're actually expected to see revenue growth. So we'll see what the market tolerance is for any blemishes in first quarter earnings, again, with the backdrop that I talked about.
One thing I want to say before I go back to you, Ira, is hearing Peter talk about how we're in this tightening environment versus an easing environment reminds me so much as a technical trader as to where if primary trend is up or down, the market seems to shrug off news as long as it remains in primary trend. To me, what's happening is instead of looking at it from a technical aspect of, we're above moving averages or below moving averages, the cycle has changed with the Fed. So therefore, now we're in this environment where because we don't have the Fed, we're actually in this mode where news is being treated differently, and it's something that I think that traders and investors really have to adjust to.
Anthony, that's absolutely a great point, and I know Peter's made it. You have to adjust. Again, if you're a trader, especially, it's a battlefield, and I don't mean to make light of that and compare it to like being at war, but it's the same type of mindset that you have to have, and you have to continually adjust. When the terrain on the battlefield changes, you better damn well move with it, because if not, you're gonna wind up in a body bag. And this time, I refer to that as bankruptcy, because you need to adjust. And there's too many people out there who are so stayed with their view, what I call, static analysis. It's great. It's my problem with a lot of models. They're way too static. And you rely on that analysis. And you know what? I think the Fed is guilty of it. So as long as we're going to discuss that, the Fed view, and actually it was interesting because one of the few questions to Powell in his appearance at the Economic Club of Chicago was he actually gave credit to something you and I have talked about a long time, is that he says, I can't, the models don't show it, and I can't really tell you exactly what it is, but it's really intuitive about how much pressure on wages comes from foreign labor sources. Carmen Reinhardt and her husband Vincent wrote a piece recently, and that's exactly right, and yet the models don't have it. It's a totally domestic-based model, and that's why, in that regard, I think the Fed has gotten it so wrong, but their analysis is phenomenally static, and the reliance on NAIRU, as I jovially say, NAIRU, which is the non-accelerating inflation rate of unemployment, versus NAIRU, which is a billion workers from India entering the global labor market. That's, to me, much more important than the Fed's NAIRU. So, again, that's a dynamic thing, and it's always shifting, and you better well shift with it.
All right, I want to stay with you, Ira. You've already mentioned Fed Chair Powell, so I'm curious, what are your thoughts on the job he's done thus far? I know it's only been a short amount of time, but I'm also wondering what you think we'll continue to see from Chair Powell and if he's made any impact on the markets.
And I wasn't an early fan of Jerome Powell for certain reasons. Of course, it was, his response to a question I asked him directly back in 2016 about, his response was that Europe had a printing press. But I think I like the fact that he seems comfortable not setting policy based on the most recent action in the equity markets. I can't stand when central banks react to daily changes in equity markets, because it's it's insanity. You know, that's the leftover from the Greenspan, Bernanke, Yellen days when they were terrified of what markets did. So I'm glad that he's more comfortable with that. Outside that, I just don't, I don't have a handle on it yet. I'm more concerned just about what you talk about. Powell's a financial guy. He's not an academic. So is he concerned like we are about the flattening of the yield curve? And if he is concerned, then I think we're only going to see 2 rate rises this year, because the long end is not reacting to too many rate rises. It's reacting to the fact, it is rate rises. That's what's flattening the curve, because they think the Fed's going to be too aggressive, while, as Peter has magnificently talked about for the last 12 months, quantitative tightening in the system. That's what's, to me, leading to the flattening, because they're squeezing the short end. We see LIBOR, for whatever reasons, going up. And the long end is going, well, maybe the Fed is moving too aggressively here between the 2 components, raising rates while quantitative tightening. And then I'll let Peter finish from there.
Yeah, no, I agree with that. And I think, for the last 2 cycles, at least, rate hike cycles, it paid to flatten the curve because the market knows where this is going to end up. And on the data standpoint, on Friday, the global city surprise economic index went negative for the first time in a couple of years. So there's been a slowdown in global growth. Plus, you throw in the economic uncertainties with the tariffs, and it makes perfect sense to flatten the curve. Now, that said, we're seeing this flattening, but still the general rise in rates is higher. Even today, we've seen how choppy the equity market is this year. The 10-year yield's still up almost 30 basis points year to date, even with all these concerns, even with the potential for a growth slowdown. So that tells me that there's a new complexion in global interest rate, in U.S. interest rates, and how they're responding to what's going on here. I think that tells you that, this debate of, okay, when's a 10-year going above 3%? Well, to me, it's inevitable, because they've only been able to take the 10-year down to 278 here, 275 at the bottom. I think that's a telling thing.
Hey everyone, I hope you're enjoying the show so far, but I want to pause and thank one of our sponsors, Trading Technologies. I started using TT in the year 2000, and I love it. It is by far the best trading platform I have ever used, and I've tried a lot of them. With TT, you can trade the global markets from virtually anywhere in the world. They are the world's fastest commercially available futures trading platform. I highly suggest you go try out TT, especially because you can try it for free. Just go to tryttnow.com and set up your account. Peter, although I do agree with you that we are going to see a 3% or higher yield in the 10-year, I have to say the last couple of months has been very, very tough trading it. Execution has been difficult because even after we saw that low made in the S&P and we saw a big move higher, I thought that it opened up the doors for treasuries to go back down and potentially make some new lows in the futures, highs in the yields. Just hasn't happened. Even after days where we get really good data, there's very little follow through to the downside. It just seems like the sellers have kind of gone away. Much different tape to me than we saw prior to February. And to me, it's always about the reaction. And in my strategy, I can tell you, it's just been a little bit more difficult to have the full belief that we're going to see that 3% 10-year or even higher.
Yeah, because we had that real initial short move, even of 295, and I think now you throw in obviously the correction in the stock market and tariff concerns and global growth concerns, and you're seeing this little drop down. But again, we're still up a decent amount on the year and on the long end, and I think that's telling because now for 35 years deficits didn't matter. Well, now if we've seen the bottom in yields, maybe deficits do start to matter if we'd entered into a multi-year bear market, and that trade deficits where the CBO said that we're going to reach near $1 trillion in fiscal year 2019, will be over $1 trillion in fiscal year 2020. Now, talking about deficits, again, for the last 35 years was irrelevant to the action in the bond market, but maybe this time it does matter. Maybe you combine that with the Fed buying less. Maybe you combine that with foreigners buying less, and that all of a sudden this does become a big deal, in addition to what the market's perception is on growth and inflation. And that just throws a whole new dynamic. Now, in terms of the Fed and Powell, I mean, I think the Fed wants to raise 2 more times this year, and they even want to raise 3 more times next year because they want to add ammunition to their gun. And they know that with the Fed funds rate today at 1.625, well, they have almost nothing to deal with any issues that come our way. They know that the balance sheet is just still way too big, leaves them no room to deal with externalities, and that a lot of the rate hiking cycle at this point is just to take back some of what they gave us, irrespective of where inflation goes from here. Assuming it doesn't change much, and assuming that the labor market doesn't change much. So it's sort of a, we went through a time frame where the Fed's economically dependent on the data. It's all data dependent. Well, now it's less data dependent, and we need to fill our gun again. And now, of course, that will eventually lead to the recession. That then leads to the next down cycle in interest rates. But if this cycle ends and the Fed funds rate's not even above 2%, well, Mr. Bernanke, who said that I'm a student of Japan in the Great Depression, well, he just repeated every mistake that the central banks then did in cutting rates to nothing and leaving themselves and trapping themselves in a low rate environment that they can't get out of.
Ira, I want to pick your brain a little bit about equities, specifically the S&P. We see how they continue to trade. If they continue to get cracked and they start going after that recent low that we had back in February, what do you see happening in the Treasury market? And I ask that because the equity market it's very hard for us to really kind of determine what's going to happen if that low gets taken out. I'm more curious what happens to the short end of the curve. If we do see equities really get beat up more, do we want to sell these rallies in 5-year and 10-year to look for rates to continue to go up, or is the S&P weakness going to push the 5 and 10-year with a rally? It looks like rates are going to go down.
You know what, Anthony? It's hard to make an outright call here. I'm much more interested in the curves because that will tell me what I need to know. And let me tell you, flattening curves are not historically beneficial to an equity market. It's not. I can't tell you exactly what the time lag is, 6 to 8 months, but they're not positive for equity markets. I've stressed this over the years for everybody who's read, things that I've wrote. And you and I have discussed this. I think the equity markets would much more like to see a steepening curve, which it either comes from the Fed taking their foot off the pedal, as far as tightening, or off the brake, I should say, and the tightening, and then we'll see the way things would start to play out. I'm not buying the earnings season. We may get a rally here and rally there, but Peter has been right, and he will continue to be right on that. We're in a tightening cycle, and that will be far bigger than the earnings. Everybody's talking about the tax-based earnings, increasing. Well, let me tell you this. If they continue to tighten because wages go up, that's negative equities. Because you get a feedback loop there that works against equities. Peter knows the numbers, so he can fill this in, but there's so much corporate debt. And I'm not talking about just junk debt. I'm talking about investment-grade debt that has been taken on for stock buybacks or dividend payments. Go look at Toys R Us with the private equity world, which, of course, they always destroy companies as they load them up with debt, and it's fine until the interest rates start rising. And then it's not so fine, and that's what we're experiencing. So this is a difficult situation that investors, they're being sold this idea, earnings. Okay, I know earnings, but earnings will be susceptible to wage increases or interest rate increases. And if they both come together, I think that feedback loop will weigh heavily on the stocks, and these people are talking about earnings. They won't outrace the cost of higher wages and higher interest rate costs.
So, Peter, basically what I was asking Ira is, are we going to see the risk parity trade unwind? That's in a nutshell what I was thinking. Are we going to see at some point, if equities continue to go lower and those that are buying 5-year and 10-year and even 30-year as a safe haven? Does that stop and all of a sudden we go down together? What do you think?
Yeah, I mean, I think that's what will inevitably happen. I mean, we created this epic bond bubble, and anything that priced off the cost of money and interest rates was a peripheral bond bubble as well, and that being, the equity market or New York City apartments or pieces of art or antique cars. So, yeah, basically what you're saying is, can we see a situation where bonds and stocks go down at the same time? And we certainly already have seen that. To Ira's point on sensitivity to rises in interest rates, I mean, it was a 30 basis point rise in the 10-year yield that blew up an entire $1 trillion plus short volatility trade. 30 basis points. That's all it took. So, getting back to the debate on the yield curve, and what Ira talked about is corporate balance sheets being historically levered up relative to cash flows. It's not going to take much of a rise in interest rates to cause problems. I mean, you just look at LIBOR and you think about all the trillions of dollars of debt that's priced off LIBOR, that's resetting every month. And if you don't have the cash flows today, well, you're not going to have the cash flows in 3 months because the cost of capital keeps going up. So that's another reason, I think, why we're seeing this flattening, because the bond market knows that we're hugely sensitive to these small changes in interest rates, because I hear all the time, oh, well, rates have gone up, but they're still historically low. And I think that really misses the point. Now, talking about earnings season, at the highs of January 26th in the S&P had doubled from the December 31st close 2012. Assuming we get about $155 a share in earnings this year, which is the estimate, which prices in the corporate tax cut and prices in a pretty vibrant environment, earnings from Q4 2012 through year-end 2018 will have been up 60%. So S&P is up 100%, earnings up 60%. So when people say, oh, stocks are fine because earnings are going to be great, well, we've priced that in not once, but almost twice. So that's, I think, people have to understand that's not a reason anymore to be buying stocks. The only thing that will keep stocks at these levels, if we, number one, grow into the multiple through an acceleration of earnings, or number two, the PE multiple stops dropping. Because that's what we've seen year to date. We've seen a reassessment of multiples. The initial correction was, I don't want to pay 18 times earnings. I only want to pay 16 times earnings. So we have more than a 10% decline just on a PE multiple rethink rather than any change in earnings per share.
Last topic for today, guys. I want to talk about the dollar, and I want to talk a little bit about gold. We talked about how we're in a tightening environment, and typically when we're in that environment, you'd see a strong dollar. You mentioned earlier, Ira, that when Kudlow was announced, he said, buy dollar, sell gold. The exact opposite is what's been happening. We'll start with you, Ira. Why do you think that has been the trade lately?
Anthony, we've discussed this for you and I certainly for well over a year. And, I had my feelings as to why people were bullish dollars. And I will have to say this, Peter Boockvar from 106 to 107 on the euro, he was bearish the dollar. And it's in writing, so he felt one way for a reason. I felt another way because I remember talking about it quite a bit. So you're talking to two people who have not been bullish dollars for many different reasons. And you're right. With fiscal stimulus and tighter monetary policy, that is generally the recipe for a strong currency, at least in the short term. And we have not seen it. I think a big part of it is that this administration and the world understands it is not a bullish dollar advocate, not yet. And, Mnuchin and Ross, as they say, they're sending soldiers to the rampart to fight the trade wars and currency wars that take place every day. That's their words, not mine. They said it at Davos, and people like to make it de minimis, but I don't think so. They're serious about it. They don't want a strong dollar until the underlying fundamentals demand a strong dollar. And I'll tell you what, with the growing deficit, both deficits, trade and budget deficits, fiscal deficits, those are not positive to currency, and the market is adjusting to it. throw in the mix that China, of course, threatens to depreciate. But Europe becomes interesting now because people are beginning to understand a lot of this tariff discussion is directed against Germany, who runs the largest current account surplus in the world, bigger than China, and they're going to feel the pinch of this too. So now what does Europe do with their currency? Where the Chinese have let their currency appreciate, how much more can the euro appreciate before it really starts to wreak havoc on the weaker European countries such as Spain, Italy, France, certainly Greece and others? They don't need a stronger currency. So this becomes, part of the problem. As to gold, I will keep reminding people, I don't care that gold is purportedly a hedge against inflation, because in this environment, I'm not accepting that. Gold is what you want when central banks start to fear a resurgence of disinflation, rather, we're not even getting to deflation, and at these ultra-low interest rates, that the central banks of the world begin to panic. I think the Japanese are in a situation where they're panicking now. And I think the European Central Bank, Draghi is really caught because he's watching the Italian situation, and it makes him very nervous because we haven't even discussed that, the way that political situation plays out. Gold, if you're only buying it in times of inflation, I think that'd be a big mistake, because we've learned that central banks can really beat back inflation by raising interest rates. The real fear is deflation. And if we entered into prices at least not rising, in fact started to go down, I think you would see central banks begin to panic and invoke policies that would send gold to all-time highs in a very short time.
Peter?
I agree with everything Ira said. I mean, I think we're entering into an environment where the Fed has barely raised interest rates. I mean, they've raised 6 times. And interestingly, in December 2015, when they first hiked, the real 5-year yield was 50 basis points. They've now hiked 6 times, and today the real 5-year yield is 50 basis points. So that also helps to explain why gold is up $300 from where it was in December 2015. I mean, look at Europe. Europe is going to go into the next recession with interest rates still negative, and a bigger balance sheet relative to the Eurozone economy than the U.S. Well, what are they going to do then? Japan. Well, we know what's going on with Japan. So in this fiat currency world, getting treated as they are by these central banks, and it's clear that rates will barely be higher than they are today in the next recession. Well, I don't know how you cannot own gold in this type of environment. But I think the real rates being as low as they are is one of the main supports.
Well, Peter, what do you think about the dollar and why that's trading so weak in a tightening environment?
Well, also to what Ira said about debts and deficits, I think being a huge factor. An administration that does not want a strong dollar. And Europe had its best economic growth rate last year since 2007. Now, I'm not saying that it's that exciting in Europe, but there is some vibrancy, relatively speaking, there compared to where the growth rates in Europe have been in the past. Asia, of course, is still always going to be drawing capital because there's healthy growth rates there as well. And just being a tape watcher, and the dollar obviously can't get out of its own way in light of all these perceived positives. But I think also people are realizing that U.S. interest rates is only so much higher they're going to go in terms of the Fed. People don't believe that they'll raise nearly as many times as they say they want to. And we know where this all goes. We know the Fed typically hikes us into recession, and they quickly reverse that with rate cuts. And there aren't many rates left to cut if they happen to get to that. And imagine where the dollar is going to go when this rate hiking cycle ends. It's going to really fall a lot, and probably surprise a lot of people to the downside.
Guys, this was excellent. Peter, where can people find you on Twitter, and give us a website to check out?
Twitter, they can see it at Boockvar, and they can read my work, daily work, at bookreport.com, and that's BOCK report.com. And if they're interested in investing, they can go to Bleakley.com.
Ira, where can everybody find you on Twitter and a website, please?
Well, the Twitter handle, you probably know it better than me, and just to read the blog that I haven't been writing as much for several reasons, but because it's the same story every day, and I can't outrun the tweets that come from the White House. So, but I write that, well, you can register for it at iraharris.com, but it's Notes from Underground, and you could follow through my stream of thought about where I think the world is at any given
Ira,
time.
I found your Twitter handle, Ira.
Okay, thanks.
At Ira Harris.
Okay, thanks, Peter. That's how. But you know what, Anthony, I'll leave this, and one of the things that I will talk about, I have talked about, and actually Kudlow picked up on it today, is the weakness of the peso since NAFTA began. And that this is part of the issue. So it tells me that there is concern about currency valuations, but we'll get to that next time with you.
Yeah, everyone knows where I stand. These are two of the best people to follow in the financial world. You absolutely have to follow Ira on Twitter, even if he doesn't know his handle. I follow him, and I'm retweeting you, Ira, and you probably don't even know it. Peter as well, and definitely go and check out Peter's book report. Like I said, I have as much respect for them as anybody else in this industry. You guys are fantastic. Thank you so much for sharing your insight with me today on Futures Radio Show.
Thanks so much.
Thanks
so much.
Thank you for listening to Futures Radio Show. If you have any questions or comments for myself or my guests, please visit futuresradioshow.com and sign up to be a premium member for free. If you enjoyed the show, don't forget to leave us a review on iTunes.